Can you actually grow a small account into a big one? The short answer is yes, but it's not the way that most people think. Because if you go on social media, you'll see people turning $100 into $10,000 or $500 into $50,000, and it looks impressive. But what most people don't realize is that those results are usually unrepeatable. They're either extremely high risk, extremely lucky, or simply unsustainable. So if your goal is to make money from trading long term, and not just one lucky run, then you need to approach this very differently. So in this video, I'm going to teach you the right mindset that will allow you to grow your account without it feeling like gambling. One of the biggest misconceptions in trading is what it means to actually be profitable. Most people think that profitability looks like turning a small amount of money into a large amount of money quickly. And because of that mindset, they're constantly chasing large gains instead of focusing on consistency. A profitable trader is someone who understands how to make money consistently over a series of trades, even if they are wrong more often than they are right. Imagine you take 10 trades. You lose 6 of them and win 4. On the surface, that sounds like you're doing bad. But if you lose 1% on each losing trade and make 2% on each winning trade, then you are still net profitable. If you lose 6% and gain 8%, you still end up positive. And that is what real trading looks like. It's not about hitting home runs. It's about managing risks and letting the math work in your favor over time. There are really only 2 ways to grow a small account. The first one is through aggressive risk taking, which is essentially gambling, and the other way is through structured percentage-based growth. This means focusing on consistent returns over time, even if the growth feels slow initially. Most traders say they want to grow their account properly, but in reality, they are constantly switching between these 2 approaches. One day they are trying to be disciplined, and the next day they are over-leveraging and taking unnecessary risks. The key to growing a small account is fully committing to the second approach. You need to treat trading as a long-term process, not a short-term opportunity to get rich. One of the most common reasons traders fail to grow their account is the lack of discipline and patience. Most traders take too many trades. They feel like they need to be active in the market at all times. They open charts, they see movement, and they feel the need to participate. Think about it this way. If you were only allowed to take 20 trades for the rest of your life, you would not take random setups. You would wait for the highest quality opportunities. You would analyze more carefully, and you would avoid unnecessary risks. This is the mindset that you need to develop. You shouldn't be taking trades just because the market is open. You should be taking trades because there is a clear, high-quality opportunity that fits your system. One of the biggest shifts that you need to make is from being an active trader to a selective trader. An active trader looks for reasons to enter the market. A selective trader looks for reasons to stay out of the market until a high-quality opportunity appears. This is a very important distinction. Every trade that you take should feel like a calculated decision, not an impulse. You should be able to explain exactly why you are entering, what your risk is, and what your expected return is. If you can't clearly define those things, then this isn't a trade. It is just a guess. Alright, now let's talk about risk. If you risk too little, your account will grow very slowly, which can be discouraging. But if you risk too much, you increase the probability of blowing your entire account. For small accounts, a more realistic approach is to risk somewhere between 5 to 10% per trade, but only if you're being extremely selective. For example, if you have a $500 account and you risk 10% per trade, you are risking $50 per trade. That is a manageable amount, but it is also enough to allow your account to grow meaningfully if your trades are executed properly. However, this only works if you maintain consistency. You cannot increase your risk after a few wins because you feel confident, and you cannot decrease your risk after a few losses because you're scared. The percentage must remain consistent. If you are emotionally attached to your trades, that will interfere with your execution. You'll start closing trades early, moving stop loss, or even hesitate to take a valid setup. Alright, here's a realistic example. You start with a $1,000 account. You take 10 trades in a month. You lose 5 trades, each at 10% risk, with a total loss of $500. You win 5 trades, each at 20%, total gain of $1,000. You're now at $1,500. Now that is extremely strong. That's a 50% return in 1 month. Now apply that same logic to a $5,000 account. You go from $5,000 to $7,500. Now imagine that with a $50,000 account. The key point here is that a strategy doesn't change. The only thing that changes is your capital. So instead of focusing on making money, a more effective approach is to develop your skill first. Once you are consistent, then you can increase your capital. Skill comes first, capital second. To summarize, growing a small trading account comes down to a few key principles. Focus on percentage-based growth, not dollar amounts. Be selective with your trades. Maintain consistent risk management. Accept losses as part of the process. Last but not least, prioritize skill development over quick gains. If you just follow these principles, your account will grow over time. At the end of the day, growing your account is not about finding that secret strategy. It's about discipline, consistency, and understanding how the math of trading actually works. If you can master that, the size of your account becomes less important because you will always have the ability to grow it, regardless of your capital. Thank you for watching, and I'll see you next time.